Good afternoon. Welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is our Chief Investment Officer, Aaron Tuttle. Welcome, Aaron.
John, I'm glad to be here.
I'm glad you're here too, because you have all the answers. I only have questions. But what a week we have had so far. Lockdowns are beginning to be lifted in various states, including here in Missouri. The PPP's second round of funding opened up on Monday, only to see the SBA system crash within minutes of opening. The market continues to climb the wall of worry, as you explained to our listeners last week, as it has continued to inch up in value. And President Trump stated the worst is behind us, at least in terms of the virus, but the economic damage ahead of us is enormous. The sense that we get from conversations with clients in the media is fear. Don't you sense that as well?
Absolutely.
In general, people seem to be negative about the future. I hear things like, we will never get back to where we were. Or I think because this event is so new, I think people continue to fear because people fear what they don't understand. And this is something new. And we don't understand all that much about it yet. Stocks have risen despite the gloomy outlook people seem to have. Even today, we had a nice lift in the market. So we are going to learn today more about this as Aaron explains what we believe is happening in the economy and in the market. Aaron.
So let's continue to review the timeline that we see each time we do these calls, and we're happy to see we're still on track. We believe we peaked on death rates in mid-April. I'll explain a little bit more about that. In addition, we stated the U.S. would relax the shutdown near the end of April. This is on track as well. The next stage is the GDP bottoms in early second quarter. So we continue to see death rate counts that are high, and it's important to point out that it's not been growing. There are still between 1,500 and 2,500 deaths most days. And I think it's a fair question to ask, have we actually peaked? The data is fuzzy, but we can see the trend is moving down, and the peak is somewhere in mid-April. There are several states that are scheduled to reopen, or some that already have opened. And many of these states are in the South. And we're watching a unique and simple index to see how much damage has been done to the economy. There may be surprise on how quick Georgia is reopening, but there should be no surprise that Waffle House is opening their restaurants. The chain is known for keeping its doors open. Because of this, FEMA uses the restaurant to gauge the damage to the infrastructure post-hurricane. Now, it's a simple index. Green means a full menu. The restaurant has power and damage is limited or no damage at all. Yellow, limited menu, no power or only power from a generator, or food supplies may be low. Red, the restaurant is closed, indicating severe damage or severe flooding. The index could be the first sign on the damage to the supply chain. Now, we're moving to the next phase of that timeline. How will we gauge the GDP on when it will bottom, since it's a lagging index? We will monitor two systems or two places. First, the Atlanta Fed GDP Now, which captures consensus view and their own algorithm on the GDP. Now, those that may look off to the left, notice that they already acknowledge that it cannot forecast the coronavirus on the way that they built the algorithm. Despite that, we're already seeing a negative 4% drop, at least on that consensus, which is what we want to pay attention to. Another index that's trying to gauge in real time is the New York Nowcast. The index is indicating manufacturing data, just those phone surveys like we get consumer sentiment, and retail and consumption data, all indicating a 7%, now this is annualized, drop this previous week. Now we'll watch to see when the data begins to suggest a bottom and begin to show some positive growth back into the GDP. Now, let's move on to our weekly recap of the market. And as a reminder, our current themes are inflation risk is high. We favor equities over bonds. We favor the US large cap as a sub-asset class and are bearish on commodities, which is unusual saying that we're saying inflation risk is high, real estate, and international development. We continue to follow the V-shaped recovery, though the slope of the V is slowing. Now, this is normal. So far, as John, you brought up, we continue to climb that wall of worry, meaning there is a lot of disbelief in the rally. Everyone's stuck on the present, but the market looks to the future, and that market is slowly grinding higher and higher. And we'll continue to monitor this shape to make sure that we stay on track for this theme. Now, many clients ask whether they should put money in the market or not. And we've covered that on previous calls. Long term, we believe it is prudent to put money in and have considered this a buying opportunity through the whole bear market correction. It is hard to time the market, if not impossible, but it's also very painful to put money in and watch the market sell off. Now, we have added a price point chart to help visualize the risk of putting cash in the market. This doesn't help us with timing, but it does give us an idea on decision points. Right now, the S&P 500 is trading at its resistance level of 2950. The next resistance is its 50-day moving average, which is currently at 3000. The previous resistance is now the support at 2850. Now, this does not mean any of these will hold, but many watch these as confirmation. If you break resistance, there tends to be a flow of money into the market with a quick shot upward. And if you break support, there's often a large flow of money out of the market and the market moves down. And if you look at the chart, you can see that there are quick jumps up and quick jumps down once one of those resistance points or support points have been broken. Now, with the help of the investment committee, we hope to better identify some decision points and understanding and communicating the risk when adding cash to the market. Earnings week. This is a big week for the market as companies are issuing their earnings report. Many of the names we hold in the clients' portfolios are reporting. Amazon, Google, Microsoft are all big names as well as big positions, and today are doing really well. Now, earnings over the first quarter will be post-lockdown, so the results won't be that bad. However, we do expect the companies to have lower earnings. Why? Because analysts are not worried about this quarter's earnings or even the next quarter. They're looking at the long term, and companies know this is what the analysts are looking. Now, let's go over a phenomenon called the big bath theory. It's common practice to use the income and balance sheet to bring earnings within the company's guidance. This means that there are projects and impairments that really should have been expensed, but have not made it onto the income sheet. Companies will realize these expenses now while there's cover and blame on the virus and not the company's management. We expect non-cash charges to increase, pushing earnings lower than what otherwise would have been. However, this also means clean and lower balance sheets. Coming out of this correction, we will see higher fundamentals, whereas price to earnings, free cash flow to the balance sheet, these will all be increased and look better. Now, there will be real efficiencies gained for sure in the companies, but that effect will be compounded by the lighter balance sheet after the recovery. Remember, the analysts and markets do not care about next quarter or even Q2 or this quarter or the next quarter. So this gets us into 2021 with a 4-month forward projection. 2019, the S&P earnings were $165. The consensus growth rate was 8% for earnings. So the 2020 expectations were 178. December 31st, the S&P 500 traded at 3220. That's about an 18 times forward earnings entering the year. Now, assuming the big bath theory, 2020 is getting thrown away, and now we're looking out to 2021. Let's assume a 30% decline in earnings, followed by a 30% rebound in 2021. So that doesn't come out neutral. At 165, you're down 30%, and then you're up 30%. So you would end at 150.15. This is still below 2019's 165 number. Now, if we apply that 18 multiple at the beginning of the year, this means the fair value of the S&P would be $2,700 or 2,700 points. And we believe 150 is cautious for earnings. But I think many would object to the 18 multiple. They would say, Aaron, isn't that rich? First, what do we mean by multiple? The PE ratio is simply the price of a stock or index over the earnings. As before, you can simply determine the fair price by taking the earnings amount times the PE multiple. How do we justify the PE ratio? Well, there's an equation. Now, I won't get wonky, but this basically determines the value of the income stream, those future earnings, when accounting for the growing income stream. Unlike bonds, they do go up over time. And it compares the value of stock earnings to the value you can earn on a risk-free bond, and then justifies a PE multiple by making them equal on a risk-adjusted basis. The denominator is the expected return minus the growth rate of the earnings. The R is the required rate of return. And this is where it's important. Everything else you can ignore, but in that denominator, there is a risk-free treasury rate and equity risk premium, or how much should you be earned for taking that risk. That means that risk-free interest rate is in the denominator. If the risk-free rate goes down, and remember, treasury interest rates moved down through this, then the justified PE would go up, or the multiple goes up. Remember, 18 was the justified PE when interest rates were higher. Now, this may sound strange, but if you get paid less to hold bonds, then stocks should benefit if interest rates begin to decrease. So let's look at that higher multiple. If the justified PE moves to 21 and we still use that cautious 150, then the S&P would have a fair value of 3150. And remember, that's a cautious 150 for the end of the year or the next forward 4 months. Now, I do want to get to both the inflationary and deflationary risks in a future call, because depending on area, a credible narrative can be given. And this slide will help with that, and it will be part of our weekly update deck. Now, what surprised me, can you stay on that slide one? What surprised me today was there is a thing called the GDP deflator, and it helps adjust when you're comparing the growth of the GDP for inflation. Normally during a recessionary type pullback or where the economy is struggling, that deflator helps boost up the production because there's actually deflation in the system. Now, we're not seeing that in the CPI, but we actually saw a 1.8% increase in the GDP deflator because the items that we're buying, we're going to the grocery store and we're buying a lot more food. There are certainly things that we are not buying. Airline tickets would be one of them. A lot of recreational activity. So there's a big shift in what the basket of goods of what we're purchasing. And we're already seeing that. That surprised me to see that today, is that we've been talking about how important it will be to look under the hood of the CPI. And we have these constituents here of the CPI to do that. And it's already showing up before the economy has really opened back up. Let's run through some of these slides briefly that we'll be looking at on an ongoing basis. We're calling this kind of the fear index, and it's counterintuitive. But what this does is it takes the futures of the S&P on the next 30 days versus the futures on the S&P over the next 90 days. And when there's a lot of fear in the near term, what happens, similar to the oil issue that we talked about in previous weeks, where there were negative future contracts, and you go a month out and the futures contracts were higher. We can judge that the market is saying, well, yes, there's a lot of risk right now, but we think 90 days it'll be clear. So when we get these spikes that you see off to the left, that's actually a buying opportunity. And we'll pair this up with that price point because it'll help. Let's say you have that cash and we see a sell-off or a spike in this index, and we're saying, well, look at the futures. The futures are telling us the problem's now, not so much later. It'll probably resolve. So that would be a good time to pair with that price point on putting in cash. But what about whenever you need to take money out of the market? Let's say you're doing a 401k rollover, and if the market is very volatile, you can miss a lot of return in just a couple of days. Well, when it gets below that red line off to the on the chart on the left, that would be a good time to make those rollovers, as well as a middle ground. Now we're going to work on a fear index, so it's a little bit more intuitive because at times it feels like you're looking in a mirror on this. Now we've also discussed some inflation risk, and we've talked about this slide before where it shows the money supply. I want to move on though, since we have covered that before, to the CME slide or the Chicago Mercantile Exchange. And this is pricing in future rate hikes, or what is the probability that the Fed will raise interest rates. Now they met today, and this shows a 0% chance of a rate hike. However, this is not for today's meeting. It's all the way out to March of 2021. So a year from now, the market is currently predicting no rate hikes as a possibility for the next year. Now, this will change as sentiment of the market changes as we get through, but I found that very interesting. Next slide is the Fed balance sheet. And this is how the Fed has been using through quantitative easing, how they increase their balance sheet, which is what a lot of people say printing money. Now, they don't actually print the money. It's all through digital systems now and through the banking system, but it does show you how much the balance sheet of the Fed has grown. Now, what I like to do is overlay the S&P 500. And it starts out in 2011, and you can see that through 2016, the S&P is following along with the balance sheet. And then something happens in 2016, and that relationship seems to separate. Well, what happened in 2016? Well, we had tax cuts for corporations, and it was substantial tax cuts. And that changed that earnings multiple that we were looking at because the government took in less money and the earnings went up, all things being equal. But as we saw a rising economy and the Fed stopped their quantitative easing and they started to let those bonds that they had purchased roll off their balance sheet, basically extinguishing the money, you can see a pullback in the market where those lows start to follow that same pattern. Now, if you look at the very beginning, or that blue line for the Fed balance sheet, you see a hockey stick where the balance sheet has once again exploded. So a lot of people are questioning, how can we talk about a V-shaped recovery whenever we see so much unemployment and so much difficulty in the current market environment? And we think that this relationship is going to hold where by the Fed continuing to purchase and stimulate the economy, it's going to offset a lot of that, especially since people that are unemployed actually have very generous relative to prior the coronavirus benefits. Many times for the lower income, they actually have more money. So there is still purchasing power that is out there. So let's toggle through a couple of the other slides real quickly. This is just looking at interest rates across the globe and what central banks are doing. This will be helpful. Right now, we favor equities over bonds, but whenever ultimately we start to look at bonds again, this may be a great source to start looking at what countries or what bonds should we look to add to portfolios. Canada is one that is actually on a tighter monetary policy. Their debt to GDP ratio is much more healthier than, let's say, the US, and they're a strong country that doesn't do a lot of shenanigans with their money. So that may be a place to be able to get some yield in a developed country. Here's the US dollar. We use this for asset class tilts often. If the dollar is strengthening, you want to be in US dollar denominated assets. And if it's weakening, you want to be in just assets that are denominated in another currency. And we can see that the trend, or at least I can see, I did make it clear with some lines here, the trend has been an upward trend. And when we look at a rotation graph, all currencies, all major currencies have actually been losing against the dollar through the epidemic. We've looked at this page before. It shows that international developed commodities, fixed income, in real estate are things that we're a little bearish on, and we're overweight that US large cap. Here's a new slide. We've been using it internally for years now, but we talk about a proprietary process, the way that we measure assets, whether it's an asset or a security against its benchmark or the benchmarks against each other. This example is the benchmark against other benchmark indexes. And that S&P 500, that dark blue line across the top, is near the top. There's only 5 different indexes that are above, and a lot of that is US large cap, specifically growth, specifically technology. But you can see what's done well are the S&P 500, the US stocks in general, and emerging markets been pretty neutral. What hasn't? Well, commodities, real estate, and international developed. So this is how we're making these decisions. We're measuring the asset classes relative to the S&P 500 and against each other to make these asset class tilts. So I just wanted to take some time and kind of review some of the slides that we'll be seeing often during these market updates. I'll turn it back over to John. I think we got a lot of questions and answers today.
Boy, we've had a lot of questions today, and thanks for that, Aaron. That was very, very informative. So one of the things that you talked about was inflation, because that's one of the things that we are concerned about. But this has to do more in terms of how it pertains to the CPI and what you call your basket of goods, especially when you think about Social Security. So in other words, Social Security payments are supposed to be indexed by the CPI, but the actual goods purchased by those receiving Social Security will experience faster increases in the price of the good they purchase. Can you further comment on that?
I think I understand your question, at least the first part. So yes, I can comment on it. I know what you're asking about. So those that are on Social Security, when we're talking about their basket of goods and we look at the different components, you know, they probably don't have education as a big expense in their basket. And education has been running pretty high. But they certainly have medical expenses. They'll have food and beverages. And they're actually going to have a bigger component of their purchases relative to my basket of goods. So when you look at the CPI, the way that that is measured is kind of just a generalized person in an urban city. What is their basket of goods? Well, the reality is that those that are in retirement are going to have a completely different basket of goods. And a lot of the things that they are purchasing are things that are in higher demand. Well, that makes sense if you look at the demographics. Yes, the millennials are the largest demographic, but the baby boomers are just right behind them, and they're all needing to access these services. So their benefit is getting moved up, but it's not keeping at the same pace as their increases in Social Security. So they're actually losing purchasing power because the way that their basket of goods is comprised versus the basket of goods. Now, there's also some oddities that get in there. One, if you have a computer, we've seen, we're doing these Zoom meetings. We would have been just absolutely amazed by this technology just 4 years ago. And the computers, how much more powerful are they? Well, if you had a computer, let's say you put it in the basket and it was $1,000 and it was 10 years ago. Well, what's the computer cost today? Well, it probably costs 600 because it's gone down. And okay, fine. That basket, if I go buy a computer, it's $600 versus 1,000. It's gone down. Great. But then they'll say, yeah, but it's not the same computer. It's five
Much
times as
better.
fast.
Right, exactly. So
It
not
can
just-
do all these other components. So not only
we
is
had
it
to spend a lot more to
Right.
get the same power back,
So
even if they had that power.
it's not 600, it's 150 bucks in the basket. And the bigger the purchase item, which a lot of times were the electronics before, and think of how many things your cell phone does. All of those items are affecting that. It's known as hedonics. And whenever we look at the way that the CPI measures, it just so happens that most of them mute the inflation that is actually experienced.
Well, I mean, the reason why this is so important is because when we think about investing, as we've mentioned numerous times, is that our focus is not on preservation of principle, but preservation of purchasing power.
Absolutely.
So we also hear people saying, and I alluded to this at the beginning of our conversation today, that the market is going to have another steep drop because we haven't seen the total devastation unfold from this economic shutdown.
Mm-hmm.
I mean, for example, we just heard today that Enterprise laid off or is going to lay off 2,000 people. Mercy's laying off or furloughing between 2,000 and 3,000. Emerson is furloughing its entire employee workforce, which is incredible. Now, it's not 100% of the time, but they have weeks that they're furloughed and weeks that they're on. And so the question is, have these factors actually been priced into the market? And how do we really know how this is going to roll out?
Well, there's no way to really know, but we went over the valuations, and remember the market is future oriented. We've been doing these calls for weeks now, and I'm sure listeners can remember whenever we were scratching our head because of how much the market had sold off. We had seen virus epidemics many times before, just over the last 20 years, and never seen a correction like this. Well, what the market was doing was pricing in all the calamity that we're now experiencing. But now it's looking further and further ahead. So what we experienced several weeks ago with a 30% or greater drop in the market has already been realized, and now we're coming out of that. So it's not looking at what's happening at the moment. It's looking at what's out 3 months, 6 months, another year. Because remember, most people are long-only investors. They're not worried about the price and the valuation of the index right now. They're worried about it 5 years, 10 years from right now. And to be fairly valued or to be possibly undervalued, those long-only investors, and that's where the majority of the money is, mutual funds, pensions, et cetera, they're going to be taking that opportunity, and they can ignore this issue that they know 6 months out is probably going to be an issue that's in the rearview mirror.
So we had a question that just came in. It says, seems reasonable to expect some significant market drops through the recovery.
Mm-hmm.
How does the investment committee position to take advantage of any significant pullbacks in the market?
We would, using our technicals and kind of assessing that situation, we would probably look to be adding additional risk. I can tell you I'm not as, and the investment committee, I'll speak for myself, but I'm sure the investment committee would agree. We would be less likely to add additional risk to portfolios at this moment than we were a few weeks ago, whenever we were still down at such bargain basement prices relative to what we could project. Remember, we did 2,700 for fair value. When we were in this, we did 2,700 for fair value, and we were well below that.
Right, and we're right back at the fair value. So
Right.
I mean, what that would seem to indicate would be that we're fairly valued. So if there's a drop in the market, there's going to be something more exogenous than what we're looking at.
Right. And we're not priced to perfection either. So
Right,
don't hear that. That 150 we think over the next forward-looking projection all the way out to 2021, we think is still a pretty cautious number where it's still below 2019. But we'll like always, we're going to base it off the technicals. We're going to base it off the data and the buying opportunity is not as attractive as it was a little while ago. Now, if we get down to those valuations and things look like they're going to be attractive, and there's actually more stimulus, because you would think the government would do that again. They really have not suffered any pain from it. Then we would make those assessments. But we'll be data dependent, and we do think that the V-shaped recovery is unfolding, but we are not here to be dogmatic or right. We're going to let the information guide us to the right direction, and we'll change our minds if the data tells us to change our minds.
Well, we were talking, it was either today or yesterday, we had the recent news about COVID showing up in the meat production facilities. How will this be affected, and what will this mean to consumers and to the market?
So if anything keeps me up at night, it's this. It's specifically the meat supply for us.
Well, I do know that you're a carnivore, so I
can
see why that would be.
I would have nothing to eat at that point. But what is happening? So farmers have plenty of animals, and there's plenty of demand at the grocery store. I was walking through the grocery store the other day, and the only beef meat that was available was hamburger. Now there's a lot of hamburger, but I wanted a treat. I would like to have a ribeye, just because it was one of the days that we were all experiencing at home, right? But you couldn't get it. So the issue is in the meat packing plants. Tyson's been very vocal. Smithfield's does most, I think it's 5 or 10% of the pork that is on the grocery shelves comes through Smithfield. And they're having issues with their workers getting coronavirus. And they're having to let them not come into work because it would be too dangerous. But at the same time, it's really put a pinch on the meat supply that isn't processed or packaged. So we have plenty of hamburger, we have plenty of sausage, we have plenty of hot dogs, deli meat, because all of that's processed and packaged. But those the animals that have to be processed and shipped quickly, that's where the issue is. And like I said, if there's anything that keeps me up at night, my bias is a carnivore, sure, but it's the meat supply.
So you may be eating hot dogs instead of steak the next few weeks.
That's right. Now, the one thing that I would put on that is this is a meat, the meat that you're finding at the edge of your grocery store, not the processed, not any of the carbohydrate things that we've stored up. We have plenty of that, so we don't have a famine. We just have limited options when it comes to meat. Now, if you know a local farmer, they have animals, they'll probably charge you a decent amount because they can. You can still get it if you can bypass the big producers like Tyson and Smithfield and get local.
So that could be a boon for the local farmers.
It probably is a boon.
So last week we were talking about oil, and by the way, you remember when we early on in our broadcast, we were talking about we really had 2 black swans, the second of which is the oil industry. And there's a lot more that's being publicized on the COVID because that's fearful. That's affecting your lives, where people look at the price of oil going down, they go, well, that's actually good news for me. But it's not good news for the industry or the economy. So one of the things you said was, if oil stays below $20 a barrel, we will see bankruptcies with companies in this industry. So who will be the survivors if this, in case it actually rolls out that way?
So the survivors are going to be the bigger oil companies. And I'm sure that there are some smart people with sharp pencils that know the smaller players very well and can find the few that are going to make it through, and they're going to be very handsomely rewarded to finding those. But those small players, especially in the fracking area, have basically used high yield bonds. That's one of the reasons we went to convertibles and not high yield bond, is because the energy sector, specifically the shale producers, fund these wells through high yield debt, and they roll that over and over and over. Now, a lot of people or a lot of headlines are that this oil is war is between Saudi Arabia and Russia. I don't believe that that's the case. I believe it is trying to push the high cost producers in the U.S., because the U.S. is now the largest oil producer in the world, out of the market, or get them to go along with the cartel. So I think the ones that are most susceptible to bankruptcy are the smaller players, that especially those that are in the fracking business, as well as the suppliers that are not. Halliburton is a fairly big player; they'll probably make it through, but any of the other suppliers are going to be hurt.
So how's this going to impact the airline industry? Because you see here all these airlines, they've gone out and bought future delivery of oil at these higher prices, and now they have this opportunity to get it at really low prices, but they have no idea what their actual demand for flights are going to be. So how does that work together?
And when Boeing was talking about their forward guidance and forward earnings, and they say 3 to 5 years before they can get back. So yes, we think the economy will get back well before then, but there are certainly sectors, the oil sector, the airline industry, airline suppliers, aerospace industry, all of them have a long road to go. And those, like I said, Boeing is 3 to 5 years, and I've seen other industries also say it's going to be 3 to 5 years before they get back. And the airline industry, I'm sure, would love to be able to lock in these prices, but they need to consider. They're not known for keeping lots of cash on hand. I mean, they're basically similar to the fracking industry. They're running companies on leverage, on debt, and they're going to make those payments. They can't be stockpiling the oil price. And to your point, what does demand look like on the other side?
Yeah. Now, assuming the Fed keeps interest rates where they are through March of 2021, as it showed in your slide, what should we expect to happen in the bond market over this time period?
Well, I would continue to say the bond market's tricky. We are trying to stay higher quality, shorter duration, to remove that interest rate risk, but still try to offset the inflation risk that move does. But there really isn't. You're not getting compensated on the long end. Does that mean that interest rates are going to move up if we see inflation? I don't think it does. The Federal Reserve is keeping interest rates down, and we saw their balance sheet. They have an infinite balance sheet. They can make that thing as big as they want and continue to buy assets. And it used to be that the Fed could only control the front end of the curve. Well, the whole point of quantitative easing is so they can go out on the long part of the curve and buy securities. After 2008, those securities that they were purchased were still U.S. Treasuries. They now said they can buy ETFs of corporate bonds, including high yield. So high yield is one of the ETFs that they can purchase. Now, from what we've seen, they have not done that yet, but the Fed can jawbone. I was talking to another analyst today, and when I came in prior to 2008, we talked about Fannie Mae and Ginnie Mae, Sally, all the GSEs, and that there was an untested but implied belief that the federal government would step in if these entities were to default. And 50% of the people agreed with that, and 50% said, no way, that's not capitalism. You got to let these things go under. And the other people were saying, well, no, it's a government-sponsored entity. The government's got to step in. And we now know that they absolutely stepped in and they bought that paper. But here we are. We get into 2008. Not only do they buy the debt of these quasi-private companies, they buy treasuries. We're not even talking about quasi-private companies. We're talking about real companies that the Fed is now buying. So I think interest rates can stay low for quite some time despite inflation, but you're not getting compensated because of that. There's actual negative yields on these bonds. It's called a liquidation in economics, where the government bonds are below inflation. That's one of the ways that we want to deal with this debt problem, is inflated away. So I would say bonds are tricky. It's too difficult to really understand, especially with all the many tools that the Fed has on what's going to happen. We just think that you're not compensated right now for the risk that you're taking. And if we do see a movement up in bonds, the interest rates are so low, the value of the bond will be hit very hard.
Well, it's interesting. I think back to 1981 when we started this company. And do you know what the Fed fund rates were in 1981?
I think they were 21.
So I checked it today. The highest point in 1981 was 19.99% on June 1st. I was just getting started getting this thing going. And now the Fed fund rate, that's just the rate at the Fed. So when that translates out to a bank in a money market, that means 23 to 24%. And I remember being able to go get a money market for 23 or 24%. Can you imagine if you had that today? Why would you ever even own a stock, right? But what's the point? When we're talking about inflation, and I think at least for my generation, when I think about inflation, I think about that very high inflationary times. Do you think we would ever get back to that point? So when we're saying inflation risk, what exactly are we talking about?
I think we're talking about a 5 to 7% inflation rate. What we're not talking about is hyperinflation. That would take several more moves like this and a significant loss in or psychological disbelief in the currency and its ability to hold its value, which is you're talking about Paul Volcker as the central banker at the time.
Exactly.
And they had prolonged inflation through the 70s and into the 80s. Around that, and it got to the point where they believed that the dollar was in jeopardy of losing a lot of status and a lot of value. And Volcker drove the interest rates up to very, very high amounts to kill that inflation. Because though the interest rate was high, let's say it was 7%, inflation was 8 or 9. So you were still losing purchasing power relative to the inflation. So it took 20 to 23% rates to kill that inflation. The thing is, we can't do that now.
So what's different now with back then?
We have a $22 trillion deficit. Who knows what it is after we see all of the stimulus. If we were to do a 10% interest rate on that, it would be greater than what the government brings in. So then that means there's still deficit spending. And that's just the interest. We haven't talked about Social Security. We haven't talked about Medicare. We haven't talked about defense spending, all the things that are in there. And the way that they have been issuing bonds. I scratch my head every day waking up. Why doesn't the government offer a 100-year bond? Lock these rates in. What, you can pay 2%, 3% on a 100-year right now? Great. I would be doing that in a heartbeat. Instead, they continue to try to keep the interest rate expense low by going to 3-year, 5-year paper. A lot of times, just at basically the Fed rate at the window. Well, that means that if we do get higher rates, it's going to show up quicker. I think the maturity is somewhere between 4 and 5 years on an average maturity for the bonds.
So let's forecast a little bit.
Okay.
Because we're saying that they're going to keep rates basically near zero for almost a whole.
That's what the market is indicating.
But we're seeing prices go up.
In some goods.
In some goods.
We're not seeing it in oil. We're not seeing it in airline tickets. These are all big ticket items in that basket. Where are we seeing it? We're seeing it in food. On that GDP deflator, the increases in some goods are so high relative to others that we actually had a positive GDP deflator.
So when would we expect interest rates to rise then? Now, of course, I'm not saying that we can forecast this with our crystal ball, but given the amount of debt, the situation that we're in now, the expectation there is going to be no increase from the Fed standpoint for a year. What does it mean 2, 3, 5 years from now for interest rates?
Well, I mean, we certainly are messing with the function of the market to determine what the price should be. It used to be that bond vigilantes would step in, and if inflation moved up, we'd get that inflation priced into bonds rather quickly. With the Fed buying those bonds, and they could certainly go and buy as much as they want, which is inflationary in itself, I don't know that the bond vigilantes can really drive the interest rate up because of inflation fears in the way that they did before the Fed started acting this way.
Now, I wanted to ask you another question, and then we're running out of time here, but over the long run, small cap equities have outperformed large cap. What is your outlook on small cap equities, and when would we begin to step back in? I mean, what would have to happen? And the reason I'm asking that is that if they've been beaten up so badly, isn't this the time to buy? Or what is the reason for us not going in right now?
Well, so you're referencing what's known as the French Fama model, which says value and small have an excess equity premium that gives you a higher return relative to the risk that you take. And
that's modern portfolio theory.
Efficient market hypothesis.
Efficient market hypothesis,
which is a building off of modern portfolio theory.
Which is not so modern anymore.
I know, it is fairly old.
Years old.
It's fairly old. And it's whenever Eugene Fama at the University of Chicago put that piece together, it was spot on. It hasn't really worked since. So if you've been overweight value and you've been overweight small cap since 2008, you've underperformed the S&P 500. And there's probably a 1,000 ways to try to explain that away. Was it that everyone, once they realized that there was this premium that could be had buying value and buying small cap, that they all ran there and the price was inflated, and this is just reversion to the mean? Sure, that could be one explanation. Another explanation, and the reason that we have favored large cap so far through this, is because who has been hit hardest through this downturn? We saw it in the first PPP, right? A lot of the large corporations, whether it's Shake Shack or hedge funds, they were able to get access to that money at a faster pace than the small companies. The companies that are getting hit the most whenever you get all of this intervention are the people further away from the power levers. So we have been underweight the small and mid cap stocks through this, because it seems to be the large cap stocks have benefited most because they're closer to a lot of the money and a lot of the decisions that are being made through regulations, et cetera. So that's why we've favored them. Does that mean that that's the right answer? We don't know, but what we do know is our technicals keep driving us there. Now, prior to this week, the large cap was and still is a leader year to date and where we want to be. But there's also a thing called a dash for trash, where during the correction, all of a sudden, a lot of those unloved, low quality stocks begin to rise at a rapid pace as people go into it because of that phenomena that you had talked about. And we're seeing that. And we're going to let our technicals drive us, because our technicals are telling us what is working and what the market likes, and we try to shift client portfolios towards what is working and what the market likes. Because of Eugene Fama's other thing, which is momentum. Momentum also brings a risk premium. We're measuring that through our relative strength. What is working? What's actually going up at a faster pace? Or whenever we're in a bear market or going down, what's actually holding up better? And that's how we define that factor.
So one other thing, and I know that we're a little bit out of time, but the international and emerging markets, have been hit very, very hard. One of the other factors in terms of portfolio management is not as much that they've been hit hard, but there's also the relationship of the value of the dollar relative to foreign currencies and how that impacts it. So since the dollar is higher and continuing to decline, will there be a point where the dollar declines and it makes more sense to go into the international markets?
Yes, absolutely.
Can you comment on that?
Yes. One of the reasons that we have not been 100%, let's say, U.S. domestic stock is we want to diversify versus revenue. Now, the benefit of having the S&P 500 is about 40 to 50% of the revenue actually comes from international markets. So it already has kind of a diversification to it. But emerging markets also allow us to get access in case we're wrong about the dollar or we have a sharp correction, because that's certainly possible. We don't think it's going to happen, but it's not out of the realm of possibility. And emerging markets, whenever you look at demographics, you look at their growth, they look a lot better on a fundamental basis than the international developed markets. Bill, on our last call, he talked about just the makeup of companies. They're fairly old style companies. They haven't had the innovation that the U.S. has had. They haven't had the innovation that emerging markets have had. And emerging markets tend to have a correlation to commodities. Now, other than gold, we've been fairly bearish on commodities through this because oil makes up such a large price. But having some exposure through emerging markets and some correlation relationship also helps with some of those risks.
Well, it looks like we are definitely out of time now, and we could sit here and talk about this stuff forever, couldn't we? I'm surprised we get work done on some days when we get into these discussions.
What's
So on another front, Gatewood Wealth Solutions will be returning to work at its offices on Monday, May 4th. That's this coming Monday. And of course, we'll be following the phase 1 guidelines for reopening. And as a result, we will continue to have virtual client meetings whenever possible. But the other thing that we're planning on, which we were unable to do before, is the open house to our new offices. We've only been here, well, we opened up the new offices. We were here for 2 weeks and then that was it. So we have that beautiful space waiting for us to come back. And we will have this hopefully sometime this summer. I also want to mention that we have a new member of the team joining us on Monday, Brad Fisher. Brad comes to us from a wealth management arm of a bank in Minnesota, and he's relocating to St. Louis to be part of the team. So welcome, Brad. So thanks again to our listeners today. Remember, we are on a mission to share our experience with families, helping them become and remain financially self-reliant so they can give purpose to their money. So as always, if you have any questions, please contact your lead advisor or any other member of your team. We are here for you. So long for now.